everyone to episode 159 of the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And here we are in mid-January. And like so many people, we have New Year's resolutions, right? And one of them this year was to drop a bunch of pounds and get healthy and do a detox.
It's a pretty common one, I think, for a lot of people.
Yeah, most people by now. So today's what, the 16th, 17th. Most people have probably given up.
Yeah, they gave up by now for sure.
But we're still alive and kicking, right?
Yeah, we are.
Yeah. So what are we doing with the detox? What do you mean?
Yeah, I mean, I think the reason that we're still going strong is because we decided to do a detox. We've done it before. I think we've even done podcasts on it before. But it's a 21-day program, and I think that's why we're on it, because it's a program and you stick to the program. It's not just a vague, I'm going to eat better this year, right? Or I'm going to work out this year. It's you have to follow the steps. So
it's strict.
It is strict. Yeah, a lot of fruit and vegetables, shakes, all that good stuff. But man, every time I do it, it's eye-opening how much better you feel.
Oh, I feel great.
Yeah.
I feel like $1 million.
Yeah.
So one byproduct is losing weight, right? So I'm down like 8 pounds.
Yeah.
How about you?
I'm about 14.
Nice.
Yeah.
Wow.
Feels good.
Yeah, that's great. So one thing that I wanted to point out on the detox is that we're all doing it together, right? All 6 of us at peak. And so you have this kind of herd mindset. We're a cohort, we're a team, we're doing it together, and we can hold each other accountable, right?
Yeah.
Like when Patty has a Coke on her desk, then we'll know, like, she's not going to do that because we're in the detox.
Right, because she knows,
Yeah. So, anyway, after 21 days, right, the idea is that you reintroduce certain foods. But what I find, because I've done this for like 5 years, and maybe more than one time a year, is that you don't want to stop.
Yeah.
Because you feel so good. And then gradually you introduce this and that. Maybe you have a late night out, and all of a sudden, you're off the rails. And it's really hard to get back on.
Right.
So the idea is just to keep it going as long as you can.
Keep it going. Yeah, definitely. And I do think one of the things that I think stands out to me doing it is the things you crave change, right? I don't crave the sugar like I used to crave the sugar. Now I'm thinking, oh man, I can go home, like grilled chicken salad, that's going to be great, right? And it's like exciting to think about, how those tastes have changed, and hopefully help you kind of carry it on into a longer time.
Yeah. And when you're doing it together, it's kind of like being held accountable by a coach, if you will, right? So that's kind of what we do in financial planning, right? We're your coach, we're in your corner, and we're helping call the play, but the players on the field execute, right?
Yeah.
So we can't do everything, right? But we can help you be held accountable with certain things, whatever you're trying to accomplish with your goals. So there's a little, parallel there.
Yeah, that was good.
Okay, so today's topic is the Hopwood 2023 Personal Financial Plan. So in the years past, this has gotten some good traction.
Yeah, I think people always like to know, is my advisor just saying it because, for whatever reason, or does he actually believe it? So I think this is the opportunity to say, look, we practice what we preach. We do these things because we think they're the best thing to do.
Okay, so where should we start?
Yeah, I guess just right off the bat, we've done it before, but anything stand out to you as being a big change, or anything you're doing dramatically different than in the past, or any kind of different approach?
One thing in terms of a different approach, and that is with debt. So we've talked many times about, wanting to be debt free, and that's a great goal to have, and certainly for retirement. Okay, so we're 43 this year. The kids are 15, 13, and 6. Okay, so sophomore in high school, you're at college is still a little bit away. But in terms of debt, we have some mortgages in place on our personal house, which we use that debt to purchase investment properties. And then 2 other of the investment properties have debt as well. So like a year ago, if you would have asked me, mindset would be, all positive excess cash flow to hammer those and accelerate the payoff. And now they're, one of them's in the 2s, the other like 3%. And so now with mortgages like in the 6 and 7% range,
yeah,
it's much less of an urgency. And I don't know if that is just me or if a lot of people are thinking the same way, but I'm thinking that's cheap money, and we don't need to be so aggressive. I still certainly don't want to just have it on a 30-year. I do want to pay extra, but in terms of every last dollar, I don't feel that need. So that's a little bit of a shift of a mindset. But if you say the retirement goal is 60, then certainly they'll be on 17 years or shorter. You know what I mean?
Yeah. No, I think that makes sense. And I think the important thing to point out when you talk about having debt, I think there's an important distinction to be made between carrying debt to buy to buy stuff versus carrying debt as an investment property, right? It's a pretty big difference what you're doing by having that debt, but it does make sense. If you can make 4% in the money market risk free, you can pay 2.5%, 3% in mortgage interest. It's a compelling argument, I suppose, right?
Yeah, I'm loving the money market too. So that's kind of another mindset shift is, we're thinking about like a remodeling project and everything. And I don't know how much that will cost, but I don't want to take on that expense if we have a recession and market uncertainty. But I do want to try and save ahead for something like that. And if there is, a recession or a deep recession, we want cash. Okay. And so a goal for 23 is to try and hoard some cash. And if you're making 4% on that cash, that's not such a bad thing.
Yeah, it's been a long time since we've seen fixed rates paying that kind of return. So
yeah, so if you can make 4, you could pile up some money, and you could easily use that to pay off debt. But I don't feel that sense of urgency like before. Remember, money markets were 0, and mortgages were 3.
Right.
And I just wanted it gone. But now it's a little different.
Yeah.
I feel like at 3 I have a great deal.
Yeah, you do. Kind of a discounted.
Well, like if we hurry up and pay that off, and then all of a sudden something else comes up where we want to access that capital again, you're paying over 6.
Yeah, we used to talk to people about paying it off, taking out a home equity line, and then you can always use that. But now you're paying off 3% debt to take on 5.5% debt. You know, it doesn't make a lot of sense. So
exactly right.
I think that's a good, smart approach.
Yeah. So what else?
You're Mr. Roth, right? Do you still are you still believing in it? Are you still concentrating on getting as much into Roth as you can?
Yeah, 100%. So I'm maxing out the Roth, and now the limit is $22,500 for 2023. My wife is maxing out her Roth 401k, the same amount. Plus, we already did the back doors, which is now $6,500 each. And if you're over 50, the 401ks are up to $30,000, and the Roth IRAs are what, 7,500? I think.
Yeah,
7,500.
Catch up, yeah.
Yep. So we're maxing out on all those, and then also HSA. Some people call me Mr. HSA. Not as many though. I don't want to confuse our followers.
Yeah, they know you as Mr. Roth, right? So here's something else. So obviously, we like to get new money into Roth. What about Roth conversions?
Yeah. So I got really excited in 2021, right when I started really going with Roth, and I did some big conversions, which were very regrettable in hindsight because the market was down so bad last year. So I kind of put the cart before the horse kind of thing, showing some impatience.
Okay.
And I wish I would have waited on that, okay, because I paid tax at a high level and now the value is down a lot. So for this year, it's on the radar, okay? I want to see how last year's taxes turned out too.
Yeah.
Because when you're a small business owner, it's different than if you just have a W-2. There's a lot of moving parts, and I just want to really be sure what the taxes look like in 22, because in 22 I did do some smaller conversions. Hopefully those will not be regrettable, in hindsight,
Right, and you say regrettable because, an ideal time to do a Roth conversion is when the market's down, right? In 21, the market was up, so in 2022, when the market was down, that would have been a more ideal time to do it because you're converting at a lower price, and then all the growth on the market rebound now is tax-free forever.
Exactly.
Understood.
Yep.
You mentioned your HSA.
Yeah.
Why don't you talk about how you think of that? I mean, it's nice you get a pre-tax, deduction on that, but tell us more about why would somebody consider calling you Mr. HSA as opposed to Mr. Roth?
Well, the HSA is actually more attractive than Roth because of the triple tax free, because you take all the benefits of a pre-tax 401 and all the benefits of a Roth and you marry it together. So you get that deduction. What is it this year? 7,000 and some change? 7,800 maybe?
It's definitely up in the upper limits of 7.
It's an awkward number.
Last year. Yeah, it is.
Yeah, so I have it set. So every month on the first of the month, that money goes into the HSA. And I use hsabank.com, who is linked to Ameritrade. So when you have a balance over $1,000 in the bank account, it automatically sweeps excess cash into Ameritrade, which can be invested. So that's how I do it. And I do not use the account for any expenses medical wise. Pay the medical expenses out of pocket and let the HSA grow. And, I think maybe it was like 2017 when the light bulb went on to start doing this. And maybe I'm wrong about that year. Maybe it was a year before or a year after. But, the HSA is like 50 grand. And I'm like, wow, like that can really be worth a lot of money in retirement for medical.
Yeah.
And so many people are not taking full advantage. What I mean by that is they're funding the HSA, but then they're using it for medical expenses right the next month.
When the bills come up, they tap it and use it.
Yeah. And I realize, sometimes you have to. But if we want to have the full advantage of the HSA, we take the pre-tax deduction going in, and then we invest it, and it grows over time, and that earnings is deferred. The taxes on the earnings is deferred, and then when we pull it out on a qualified withdrawal, it's tax free.
Yeah.
So if you miss the middle part, then that's a big loss.
Yeah, it is.
Big opportunity cost. Okay, so it covered some mindset shift, Roth, future contributions. We're also adding to our after-tax brokerage account every month. So this has been happening forever. The idea is we want to have in retirement some pre-tax money, okay, like a traditional 401k. We want to have Roth as much as we can get, Roth slash HSA. And then we want to have an after-tax brokerage account where it can be used for anything. It could be used to pay for college. It could be used to pay off a debt. It can be used for retirement income. And the taxes are subject to capital gains only. So I want to have all three legs of that stool, where we can manage our taxes in retirement.
Yeah, I think that makes a ton of sense. The flexibility that a taxable account has is great. So when we talk about money markets and stuff, we talk a lot about that can be the type of account that you put that extra bank money into, and now we invest in that money market account where we can earn on that money. You want to make sure we're earning on bank money, we're earning on safe money, earning on that emergency fund, because it's accessible, through an account like that.
Yep, exactly right. So if I were counseling people, I'd say you have your cash at the bank, you have your savings account, your emergency fund in the money market, and then if you still have excess money beyond what you need for emergency fund, that's your brokerage account, and that can earn the market returns.
Yeah, definitely. I think that's it. You can be conservative or aggressive in an account like that.
Yeah.
So speaking of risk, after going through a year like last year, you've always been an aggressive investor. How has last year impacted your thoughts on investment risk?
Well, we're human, just like anyone with investment risk, and I gotta say, like last May, because we're aggressive, okay, and I have leverage and margin and some options and all those add risk, okay. In May, I was just banging my head against the wall because basically, if you look at the chart, it wasn't that like the Dow or the S&P was so bad in May. I mean, it was down, but the NASDAQ just fell out of bed. That's those technology stocks.
The high growth companies, yeah.
The bottom just fell out, and so I was in a lot of pain and my we rebounded from the lows. In fact, I don't know if the value is any much better than it was in May, but the lows were in October, and we've had some rebound. But I'm still aggressive, right? I still have not changed my strategy, and I'm still adding, right? And part of me says, boy, maybe instead of with excess cash flow, right? Maybe instead of paying off debt, it should be going into buying the dip, right? I think a lot about that, long and hard. And then I realize, well, if we have a project coming due, we don't want to take out additional debt for that at 6 and 7%.
Right.
And you could buy the market today and be down even more when the bill comes due for the project. And so 4% is pretty good, right? So like we talk about with peak income conductor, if you have a need that's coming due, it's always better to have money in cash.
Yeah. And you mentioned it earlier too, and to save in advance, right? When you have something coming up, it's the right way to do it is to plan for it ahead of time, as opposed to getting there and saying, how are we going to pay for it? Right. And that's where we get into trouble with debt.
You reminded me of the Steve Martin SNL sketch.
That's a classic one.
Yeah. He's like, so I buy it and then I pay for it. And she's like, Amy Poehler, she's like, I forget the other guy. But Amy Poehler and Steve Martin, they couldn't get it.
Yeah.
He's like, no, you save the money and then you buy it. And they're like,
was this, a brand new concept, right?
Right. Yeah. So, admittedly, we've used our equity line to purchase investment properties and then we pay it back aggressively. So I was kind of like Steve Martin in that case, right?
But the difference is you bought an income producing property though, right?
Yeah.
As opposed to a new toy, right?
Yeah,
that's where I like to draw the difference on debt.
But I did go to the boat show on Saturday.
Yeah?
Yeah.
Tempting.
It's so much though. It's like so expensive, it's unbelievable.
Yeah.
These new pontoons. Yeah.
So you showed restraint.
Yeah.
No new one this year.
That's
escaped. Not in the plan.
I escaped.
Okay. Well done. Well, good. I don't know if there's any other, as far as protection, insurance, estate planning, anything there that worth noting or mentioning.
No changes with any of those things, but talking about life insurance. So we have a few new clients that they transferred in big time universal and whole life policies where they're adding buku bucks each year as the premiums. And I have one of those. It's $20,000 for the premium, which is like a big expense. Okay. But the idea is that it's a supercharged Roth, right? So if you contribute between age 40 and 60, then between 60 and whatever age, it should kick out tax-free income because of the way insurance works. And talking to, seeing some of these plans, working for a change. I mean, I've seen quite a few blow up in my day. That's why I don't preach. I see on TikTok and Instagram these financial people talking about banking on yourself using the life insurance policy. It's madness to me. Just sick.
Yeah.
I don't know how these guys can do it.
Yeah.
I don't think it'll work.
Yeah.
I'm not a believer. But I am a believer if it's done right. It's called a LIRP, L-I-R-P, Life Insurance Retirement Plan. It's not for everyone, but it can work if it's done right. So I'm happy that I have that.
Yeah.
It's just been a few years, but just reinforced that concept.
Yeah, that is true. But like you said, it's got to be the right fit, and it's definitely not the right fit for everybody.
Right. So I think maybe that's about it.
I think that covers it.
Yeah. Okay, great. Well, there's the 2023 Personal Hopwood Financial Plan. And if you'd like to learn more, you can visit us at peakwm.com.